Canada has officially entered what many economists are calling a recession. But here's the strange part. Most Canadians feel like they've already been in one for years. Groceries are expensive, housing's super expensive, rent has been going up, and for a while there, 2022 to 2024, borrowing was super expensive. And for most families, it feels like they've been just working harder and harder to stay in the same place. So today I want to answer 5 questions. What exactly is a recession? How did Canada get here? What does this mean for your job, your mortgage, and your financial future? What kind of fallout are we looking at when it comes to real estate and interest rates? And lastly, are we heading towards recovery or towards a depression? So let's get into it. So the technical definition to a recession is 2 consecutive quarters of negative economic growth. But let's break that down in terms me and you can understand. Simply put, the economy is shrinking instead of growing. Businesses are selling less, consumers are spending less, companies, large conglomerates are investing into Canada less, becoming more cautious. Canada is producing less than we're consuming. Hirings have slowed down, so the job market's become weak, and overall confidence has dropped. Kind of think of the economy like a vehicle. For years, Canada was moving forward, maybe not perfectly, but generally speaking, moving forward, and this recession has made it lose momentum. The engine is still running, the vehicle's still moving, but it's much slower than it was, slowing down. Now, this doesn't mean disaster. It doesn't mean everyone loses their jobs. It doesn't mean a housing market's gonna collapse. It just means that the economy is officially being recognized as slowing down, even though we've already felt this way for years. So you might think this is funny. People have been throwing around the word recession for the past couple of years. You're hearing it now and you're like, wait, we're just figuring this out now? The talking heads are just coming to this conclusion? I've already been feeling the higher costs when it comes to food, fuel, housing, insurance, and really every other aspect of life. So what's changing now? And the answer is, not a lot. Like I said, while economists are now using the word recession, most Canadians have been throwing that around for years and have been experiencing what a recession feels like already. You might be wondering, follow up to that, how did we even get here? Well, there isn't just one cause. There's quite an array of variables that can be at play with, moving a country into a recession. The first was inflation. Following the pandemic, governments around the world injected enormous amounts of capital into their economies. And at the very same time, supply chains were disrupted, supply struggled, prices rose rapidly, and this resulted in the highest inflation Canada has seen in decades. And then the Bank of Canada responded to that by aggressively increasing prime rate. And just for a quick caveat, prime rate really affects lines of credit, home equity lines of credit, mortgages, payday loans, auto loans as well. It's actually very connected to overall borrowing power here in Canada. And even if it seems crazy, that aggressive jacking up of rates, which I don't think needed to go as high as it did, was completely intentional. It immediately stopped consumer spending. It's completely intentional. It encouraged people to spend less, businesses to invest less, and the housing activity went from absolutely on fire to, cooling right down very quickly. This was kind of the medicine used to kill the inflation. And the funny thing is, conceptually, when the medicine works too well, it moves a country into a recession, which is where we are now. So now that we're here, let me tell you what this means for the average Canadian, for me and you. Forget GDP, forget economic jargon. Let me tell you what this means for your life. The first thing to really consider is employment, because businesses overall become much more cautious during a recessionary period. Hiring slows down, raises become a lot less common. The competition in the job market definitely increases, not to mention the already existing competition with AI. And behind your employment, financial stress. What's this going to mean for your bank account, your monthly obligations? Right now, the immediate concern in a lot of people's lives is mortgage renewals. A lot of people are coming up to the end of their 5-year term out of 2021 ultra low rate era, now in the mid 4s. So that's definitely an immediate concern for a lot of Canadians, is that mortgage renewal regarding their financial stress. And then behind financial stress, those mortgage renewals, grocery prices going up, would be consumer spending overall. People are kind of delaying those major purchases like vehicles, renovations, vacations. Not a lot of people out there buying investment properties right now. Overall, Canadians are just getting a little bit more defensive with their money, and rightfully so. And the last thing, not saying any less important, but to consider with how this affects your life, is opportunity. Because while recessions do create challenges, they also create opportunities. And this is more in respect to people that are overall financially prepared to seize these opportunities. Some of the best buying opportunities in history come from a recessionary period. The same way that when the stock market crashes, that's the best time to buy. So I'm getting asked this a lot, behind how this affects your life. What does this mean for interest rates? What are interest rates going to go? What do you expect interest rates to do? Where are they going to go up or down? And let me just peer into my crystal ball and tell you what I think. Historically, recessions put downward pressure on interest rates, meaning they're likely to go down. Specifically, prime rate, which affects variable rate. With a caveat, fixed rates move based on the bond market, and there's a whole nother set of variables that can affect that. But recessions as a whole put downward pressure on rates rates, which is really respecting prime rate, overnight rate, prime rate variable. And you might ask why that is. Well, simply put, you don't want to make things more unaffordable for Canadians in an already really unaffordable, uncertain time. And when rates are low, it encourages borrowing, i.e. buying homes, encourages more investment, just all the things that would seemingly redirect a country's path on, recovery or further towards a depression. The challenge in all of this is inflation. If inflation remains elevated, the Bank of Canada is going to, hold or possibly even increase prime rate to curb that inflation. Now, this is extremely unlikely because inflation has been in line and actually coming down for the last, 6 to 8 months. It's really a balance between two competing priorities: to drop inflation or to drop rates quickly, stimulate the economy, get people spending more money, or not drop rates too quickly to spur inflation, which would subsequently trigger an increase in rates and just, mess up everything. It really is a balance, supporting the economy and preventing inflation from getting out of control. Simply put, the presence of a recession, generally speaking, increases the probability for lower rates over time. And I don't know if this is bad news or, overall provides predictability. Those rate cuts generally will happen slower than a lot of people expect. So, for the foreseeable future, rates are going like this, slowly but surely coming down. So let's talk housing, because housing is going to be really tied to the direction of interest rates as well. Real estate values are influenced by quite a few different factors. Things like employment, rates, population growth, housing supply, that's a big one, consumer confidence, credit availability, quite a few different factors. I'd say the biggest things to stand out in that list would be consumer confidence, interest rates, and supply. In a lot of places in Canada, housing supply is still kind of an issue. Not enough homes have been built to meet the demand of Canadians. Now, a whole other topic is the affordability of these homes, but with the influx of immigration and the transition from Canadians 18 to 30-year-old age range, there's simply not enough single-family detached homes. But with that being said, in places like here in Victoria, Vancouver, a lot of Toronto, GTA area, there are way too many condos. So depending on where you are, housing supply is going to look very differently. But, broadly speaking, Canada does have a bit of a supply issue. But keep this in mind for yourself. If you're one of those people that has stable employment, strong savings, recessions can provide a huge opportunity to get into the market at prices that would have been otherwise not available 2, 3, 4, 5, 6, 7 years ago. We're really finding ourselves in a nice buyer-focused market. The word recession has been thrown around quite a bit, but we really haven't talked about a depression. So what stops Canada from moving from a recession to a depression? Great question. Let me answer that for you. So by quick definition, a recession is not a depression. A depression is not a recession. A depression is a prolonged period of severe economic decline, mass unemployment, business failures, a removal of investment from the country, and financial instability as a whole. The reason we really don't see depressions anymore is because governments and central banks have really learned their lesson from historical events. Today, we do have the tools that allows them to, lower interest rates quickly, increase government spending, invest in infrastructure, support employment programs, and provide liquidity to financial markets. The objective is simple, and it's widely understood. Keep more money moving through the economy. That keeps a healthy economy. That keeps a growing economy. Because when money stops moving, it puts us where we are today. So what's Canada actually doing to stop us from moving towards a depression? They're kind of walking quite a different line. The Bank of Canada is trying to control inflation without causing unnecessary economic damage. And they're doing this by continually spending on infrastructure and public programs. And, things like population growth, immigration are what's really supporting the job market. And it's forcing labor growth, which then forces housing demand. The real challenge is timing. Economic policy works quite slowly, and the decisions made today might take months or even years to show their effect in the economy, which means we're kind of living through the decisions that were made, several years ago. That's what's really impacting us right now. Trudeau. So, personally, I don't really think we're headed towards a depression per se, but I also don't think that Canada is doing a whole heap of a lot to keep us from, moving into a weaker economic position. I think we're going to feel continued affordability, pressure on the average Canadian household financially, and an overall adjustment that we're all going to have to make to a higher cost environment. In other words, the next few years are probably going to feel uncomfortable, as they have for the last, 3. These things really happen in 5 to 7 year cycles. So I don't think we're going to see the light for, a couple, 2, 3 more years. But, like I said, discomfort and catastrophe are not the same thing. And this type of economic position does pose a ton of opportunity for those that are ready to seize it. So keep your eyes open and try and put yourself in the best position possible to take advantage of some really cool opportunities. And like I said, this is a cycle. These things happen and are natural and healthy for a economy. We can't stay all the way up here forever. These things need to have hills and valleys. So We're currently probably not at the bottom of the valley, if that's just my own opinion, but we will experience an upswing. And none of these things last forever. We will find ourselves on the up and ups in due time. And like I said, we are more or less experiencing the foolish decisions made by those in power, call it 4 years ago. So it is what it is. We are where we are, and you can just do the best with what you have. So try and stay disciplined, try and stay focused, try and make the best of your situation. Don't unnecessarily spend money on silly things. Try and be more conservative if you can, and if possible, put yourself in a good position to seize opportunities that will arise. My name's Daniel Tidorenko. Don't be a statistic, and I hope you have a great rest of your day. If you want to chat further, you know where to find me. Google me, get my cell phone number, and let's have a chat. Bye for now.